Welcome everybody to the Capital Discussions Market Analysis. I'm Tom Nunemaker with Jim Riggio. Before we get started, we'll just go through a short disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. You don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And the disclaimer is at the bottom of all our web pages if you want to read it in its entirety. So with that out of the way, I'm going to give the other Tom, the presenter, if you want to share your desktop, Jim.
I certainly will.
Yeah, I was waiting for you to get here, and I was going to pick up the violin and just play a few notes, and my A string broke. So I have to go.
I hate when my A string breaks.
It's annoying.
Okay. I think I'm sharing now. Can you see me?
I do. I can see you, yes.
Okay. So let's start with the technicals. When I take a look at the SPX, you can end up seeing that all of the oscillators have reached a high point. The MACDs, the stochastics, the RSIs, 20% RSCCI. You can see that each one of them is up near the top of their range. Now, just because they're at the top of their range, if you take a look back here in late October, it doesn't mean that they can't live, I use the term, they can live on the ceiling for some period of time. Take a look at Williams percent R, how long it stayed above its graph, above its top line, which would say over bars. You can see it ended up climbing from, let's call it 1937 or so, all the way up until when it came up to here, up until about 1998 or so. So it can stay up there for quite a period of time, and it doesn't mean that it'll end up coming back down. However, we are getting to a point where we have had such a rapid movement on the overall market that prudence would end up saying that, if you have been lucky enough to catch this upride, do you take some off? One of the things that I wanted to end up showing you that we were looking at today, and let me get rid of these things so we can just take a look at the basic graph, and I want to do some comparisons and showing you a couple of things. If we just take a look at a basic graph, and I want to, wrong one. I do that all the time ever since they ended up putting things in different spots. I don't know if you end up doing that, Tom. This is the other thing that I end up getting a lot of. Do you see my my pinwheel, my Apple pinwheel? Tom? I just, my Thinkorswim freezes. It seems quite a bit these days. If anybody knows,
the beach ball. Yeah. No, I don't see your beach.
Yeah. The beach ball does end up going. So if I just have to come over to here and I have to do a forced quit on it and start it again. You see, not responding.
Yep.
If anybody knows, I've done a reinstall. I've made sure I was on the 64-bit version, but yet it still ends up happening quite a bit to me. And I'm not exactly sure, if it's in their code or what causes this. But and I don't know if other people have had this. Have you noticed, Tom, that have you hung up more often recently?
Well, I don't use TOS, so I haven't really noticed it. But maybe somebody else in the chat has.
Yeah, if anybody in the chat, okay, please, Tom, if you just monitor it, because I just want to line back on. If anybody's noticed, have you ended up having more issues with Thinkorswim, having it freeze on you? The other thing that ends up happening.
He's had all kinds of problems a few months ago, but not lately.
What I've found with the Thinkorswim is that if you're using Thinkorswim with anybody's sharing software, WebEx, Join.me, GoToMeeting, those are the times when I've had the most issues. The system ends up freezing up on me, and I can't end up doing anything. I did see one message that went by, said something about memory. Did you see that, Tom?
Eddie says I changed my max memory size before logging in. That helped a little bit.
To what? Ask him what he changed it to. Well, I guess I can.
Okay.
What did you change it to?
Yeah, what did you change it to, Eddie? Had it at 2,000 megabytes or something like that. I don't know do you know what yours is set to now, Jim?
Yeah, I brought mine up to 1 meg and 2 meg. I have to go and say, I'll go and check it later on, not right now.
Yeah.
Let me come over here. Let's just do 1 year daily. Let's bring this on. VX. Okay. One of the things that ended up, let's just do, I'll leave it to a short period of time. Okay. This was something that we had noticed. What you're looking at here is a 1 month graph of the VIX in the bars, and the purple line is the volatility on the VIX. So if you will, it's the VIX calculation. Instead of being it on the SPX options, it's the VIX calculation on the VIX options. So what ends up happening, and this happens quite a bit, where you end up getting this very sharp run-up in the cash. You didn't get quite the sharp run-up here, but now when you take a look at what's going on with the VIX has had a bigger sell-off recently. So what happened today, okay, and you can see today here, that the VIX, okay, which is the bar graph, has moved up quite substantially compared to where the VXX actually sold off. Okay, this is one of the things that I am taking a look at. I look at this on a daily basis. If you look on my list over here, what I wanted to end up showing is if you take a look at, here's the VIX, and right below it is the VVIX. You can see the VIX was up 5%, and the VVIX was down 1%. So that was pretty significant. Okay, you know, they've kind of, they should end up, and as you can see over a month period, they do kind of trend together. But usually, if the VIX runs and there is real fear in the market, the VVIX will catch up. Right now, they went in the opposite direction, which ends up telling me that this little sell-off that we had like late in the afternoon compared to where we were, I put no faith in it. So tomorrow, one of two things has to happen, right? Either the sell-off, okay, if a little bit of selling that we had, very little bit of pressure that we had selling in the afternoon, if it continues, then the volatility on the VIX options, the VVIX, will continue to end up moving up. Otherwise, the VIX will end up coming back down. Also, if you end up taking a look at the VXX, it was up about 1%. Again, 1.62%. Again, when you take a look at this, normally what you would end up expecting is the VXX to be, 75, 80% of the VIX. It wasn't. It was substantially less than that. So it means to me that there was some put buying, okay, sporadic put buying going on here or there, not systematic put buying going throughout the system. That being said, while we looked like we were topping on a lot of the oscillators on the SPX, this is telling me that we could end up living up there for a little while. We're also through October, so statistically speaking, we're going into the best 3-month period of the year, November through January. There's no real issue on the table right now in and around the U.S. Most of the fears going on with international stocks. The two things that we ended up also taking a look at, and let me get rid of these. Comment, I didn't see any questions. Did you see any questions on this before I move on?
No, they were just talking about the TOS memory settings. There's no other questions.
Okay, so if I go and I delete all of these things, one of the things I wanted to end up taking a look at to be able to end up showing folks is that oil has had quite a sell-off. Okay, and drawings, studies, remove all studies. Okay, and if I end up showing oil, right, CL, we broke $80 today. Okay, which is quite substantial. People might remember, what was it, about 3 or 4 weeks ago, we ended up having Stephen Shannon on, and I said tongue-in-cheek that because Stephen had bought a Tesla recently and I bought a Prius recently, oil was going to $20. I do think that oil is going down to 70. One of the things that's happening right now is that there's a lot of pressure around the world, plus also there's a lot of a dollar move. The oil movement, okay, downward, has been pretty much in correlation with where we are on the dollar. If you take a look at the euro, okay, the euro, okay, it's not that different. Breaking 125 has been pretty substantial. Tom, I mean, for you living over there, what have you seen in and around the euro with all of the, the bond buying and their version of quantitative easing?
Well, I know there was that big move in the euro, I think, caused by the Bank of Japan doing their stimulus thing. But as far as the economy here where I am is kind of in a little bubble with all the military, but, the day-to-day person on the street doesn't really think about it.
When you take a look at this, okay, the other thing, okay, you think about another commodity, maybe something like a gold, right? Similar type of graph, okay, and as you had mentioned, the biggest thing, or the reason why it's going is Abe Economics in Japan. Okay, they have gone through a quantitative easing, or they just increased their quantitative easing program to the point where it makes us look foolish. Now remember, this is dollar yen, not yen dollar. So the graph is upside down, right? The higher we go, the stronger their dollar becomes. On the euro graph that I just showed you, the lower we go, the stronger the dollar, the weaker the euro becomes.
Man, the cheaper my mortgage is.
Cheapens your mortgages, okay. Bottom line on this, if it's not too late, guys, this is the time to go, okay, on vacation in Europe because it's cheaper.
Absolutely.
Right, but you take a look at what's happened, okay, with the announcement of additional stimulus, okay, in Japan. So remember, we ended up having a conversation in the Trading Group 1 this past week, where we talked a little bit about quantitative easing and how that ends up working. Anybody who wants to end up knowing more about it, you should go and listen to it. It's about halfway through, where we talked about the effect, how quantitative easing will end up meaning that it's a risk-on trade and will push the equity markets higher. And that's what we've seen. So when I go and I take a look at how much of that money, okay, has moved into the SPX, the answer is, it's been somewhat substantial. So when you take a look at What was the sell-off? Fear internationally, fear about Europe, fear about Japan, fear about emerging markets. What ends up happening here? Don't worry, the Europeans will buy more bonds. Don't worry, the Japanese will buy more bonds. So as the U.S. finishes its quantitative easing programs, it seems that they're revving up around the world. When it takes a look at volatility that we've had, volatility had spiked incredibly, and we had looked at, the VIX and the VIX futures. One of the things that I wanted to end up showing you also was the volatility curve that we had put together for everybody, and that was the R bars. Is this the one? No. Sorry about that. Remember, these are the lines that we end up having. This is the 2-month minus the 1 month, and it's on a 15-minute basis. This is the 2-month minus the 3-month, and then the 3-month minus the 4-month. We're not in perfect contango. You almost never do get in perfect contango, and the reason why is the volatility always looks a bit stunted when it comes to the holiday season. Some people I know end up liking looking at this, and this is what you were seeing and why you were seeing it the way it was. If you take a look at the difference between the Novembers and the Decembers, that curve does not continue to get steeper, where it does it's the steepest between December and January. Nobody wants to end up owning volatility over the holiday period. It's usually owning December stuff is usually, it always gets depressed. So I take a look at where we are. The market is reasonable. This backwardation contango number, meaning that there's a 1.88% difference between the front month and the second month on the VIX futures, ends up telling me that we're much better than where we were. Right? If we had gone back at one point, we were in backwardation quite a bit. So we're more normalized right now. So I don't see anything substantial, okay, in the market. We do have downward pressure on oil, on any commodities, and that's because the dollar is becoming stronger and stronger. A little bit because of Europe, mainly because of the Japanese bond buying, and that's systematic, right? That's systematic. So it will end up having an effect throughout the market. It's difficult for the markets to end up selling off while the Federal Reserve, the big Federal Reserve banks or national banks, the Bank of Japan, the ECB, the Fed, when they're buying, it's difficult to end up betting against them. The key would be, will the economies be able to end up overcoming the weakness that they've ended up having? When the market starts to end up worrying and thinking that it's going to end up selling off, we had seen what had happened. I mean, the sell-offs can come quite substantially and very quickly and be absolutely vicious in the selling. One of the things that ended up happening, and if I end up showing you this, Friday was interesting because one of the things that my trading partner Ian Scott and I always do is that we look at just normal papers, okay, non-financial papers, just to end up seeing is there any financial news. Usually that's a pretty good sign. On Friday, a bunch of papers ended up having, okay, S&P, Dow at all-time highs, everything's fine, we're going up. Those are the times when, you should be at least cautious, to say the least. The VIX is not elevated. The BVIX, none of the volatility levels are telling me that I need to end up worrying yet. We are going into the Thanksgiving, Christmas, New Year's, holiday time. And so volatility always gets pushed down on that. It's already priced into the market. It's not something that is going to end up being dramatically different. So that's our take in the market. I'd ask if there are any other questions, Tom.
George asked, do you watch the VXST as well as the VIX?
I do. And you can end up seeing, right, George, do you see it? It's the very first one. That's because I kind of put them in time order. I take a look at it, and, you can end up, there's my pinning again. It was up 7% because it's a 9-day option. It does have a lot of meaning to it these days compared to what it used to have for two reasons. Number one, the weekly options are just, they've exploded in value. And they tell you when there's any immediate fear. So if I was looking at trying to do a shorter term trade, if I was trading between now and the end of the week, I would place a lot more credence in the VXST. But because I'm looking at things usually, 2 to 6 weeks, sometimes I'm even going out 2 months, I tend to end up looking at the VIX. The VIX also ended up having more validity or credence in my mind recently because about 2 weeks ago, the SIBO went from using just the monthly options. Remember what they try to do. They try to calculate what volatility would be for a fixed 30-day option. And they would end up using the monthly options. Now they're also using the weeklies, starting about 2 weeks ago. And so with all of the extra volume on it, you can end up seeing, without question, the shorter time frames, will end up always moving quicker. When do you have to end up worrying, I think? For those of you that don't end up knowing, the VXST is basically a 9-day continuous option. The VIX, as everybody knows, is a 30-day option. I also end up keeping up on my board over here the VXV, which is a 3-month option. So basically, it's a way to end up taking a look at where, if you will, the contango or backwardation is in the actual volatility calculations of the options, not just the futures of the VIX. And those are what I end up seeing, in terms of the differences. So, George, was that good? I mean, is that answer your question?
While George is answering, Stephen said midterm elections, market mover, as well as monthly job report this week. I know we also have international trade tomorrow and jobless claims Thursday, but those are the only market moving type events I see in the next few days. We had a long discussion about the elections that are coming up. And I think that perhaps, obviously, the thing that's in the news the most is what ends up happening, with the Senate. There's a chance, depending on, which polls you look at, it goes from, rather low to, pretty reasonable that the Republicans would end up taking over the Senate. And if so, they have both houses. I don't know if that happens. I don't know if there could be more deadlock, than there already is in Washington. I don't know if President Obama starts to end up governing with more executive orders and what that ends up doing. But it's a big challenge right now because we're not getting things
done, okay, that needs to end up being done. I think that a lot of this will end up being priced in somewhat. If you want to take a look at it, probably the two biggest elections from the stuff that I have read was Brown up in New Hampshire. Okay, is the Republican challenger. He had been out of the race. They both of them are facing incumbents. And Tom Tillis in North Carolina, because he had been an underdog for a long, long time, and he seems to be within a couple of points. So those are the two that I'd end up keeping an eye on. I'd also keep an eye on Tom Tillis because I know him. He was a partner of Price Waterhouse when I was there. He made partner 2 years before I did. A great guy, but we know nothing about his politics. So those would be the two things. Do I think it'll end up having a very big impact on the market? I don't see it having a very, very big impact. I think it's a more of a minor move. As for the other reports, yes, okay, but I wouldn't say that there's any more importance than there has been on the numbers. I think that as we end up going through this Christmas season, the holiday shopping season, we'll end up seeing the reports and where things have been in terms of retail sales and moving. But the economy it's moving forward, right? It's not blazing a trail. So I do think that now that quantitative easing is done, and we move forward, I think it's really going to end up being the language that goes on into the Fed minutes that people end up keep. I think is it Byron Leftwich? I don't know his first name, but he's an economist at Citibank. Heard an interview when he was talking about the Fed minutes, and everybody knew that they were going to keep rates where they were extended period of time before they do anything. They were going to finish quantitative easing. Right? So there were no decisions to be made. He ended up joking, saying, their biggest decision, in this past Fed meeting was going to be what to order for lunch. Which I found amusing. So those I'd end up watching the markets. I'd watch the markets. I'd watch volatility. I'd watch the technicals. I'd watch the oscillators. I kind of take a look at it that I read up on them so that I know what's going on. But what I care more so, I can't tell you how many times, if you would have given me the report on this is what's going to end up happening, I couldn't have guessed the market direction. I care much more about how the market responds to whatever news there is than what the news is itself. Okay, and that's an important thing. We had gotten into a bad news is good scenario for a while, where if the economic reports weren't that great, that was good for business because that meant that the Fed was going to push out raising interest rates even further. The amount of doves, who are voting members of the Federal Reserve meetings it's significant. So I really don't see much to end up changing for their opinion and how they're going to be moving forward. So the jobs reports is, I'd say the same influence that it always has. It's substantial. What I take a look at is not just, you have to kind of look into the jobs report always, right? What salary, what's the average work week, and the details. So you can end up finding a lot of that stuff if you end up going directly on the Fed website. And there's a couple of other places. I get my stuff from either briefing.com. I know if you take a look at the calendar, let me pull up the calendar that Tom ends up having, because it's a pretty good calendar. Take a look at it. It's in WebEx, so let me come over here.
Yeah, you can also go to the member site, too, that has the next 3 or 4 days in there. Yeah, right there.
Yep. I'm sorry, I was right there. I went back to one. Okay. So it ends up showing you what's going on, and you can end up taking a look. And one of the things I really end up liking about the way Tom's done this, if, for example, if you want to take a look at claims, okay, very nice information on. You can end up getting a very reasonable. Okay, I'll see you tomorrow. You can end up getting a very reasonable look and see where the graphs are, where the new claims are, where the moving averages are. They do a great job, I think, of the Econo Day, okay, the service that we end up using, does a good job of just kind of encapsulating it in a nutshell.
And Jim, if
Okay,
you go
so-
back one to that members home, if you click on the title, upcoming significant economic events, that takes you to the calendar.
Upcoming, and where am I reading, Tom?
Where the number 7 is, the title, right above all those dates. Yeah, right, yeah, the black, upcoming significant events.
Oh,
Yeah,
okay.
that's actually a link. So if you click that, that goes right to the calendar.
Oh. See, I had gotten here once before by following, and I saved this as a link. Very nice.
Yeah.
You see all the stuff Tom does for you guys? I did not realize that. That's actually great. I knew that these were blue. Maybe, you know what, Tom? Make that blue also. This way people end up realizing what it is.
I could.
Okay. And
While
you
you're
guys
on
know
that
the
screen,
stars, right? The stars,
Yeah.
the reds are what they end up saying they think are going to be significant market movers, and the yellow are possible movers, but not as much. And again, you can end up seeing the productivity and labor cost numbers. Oh, sorry about that.
Oh, and then if you go back to the member site, just point out a few other new things. I added a new menu called List, and if you go there, there's a list of different things that you can take yourself off or put yourself on. So if you want to get notices for the roundtable, either the trading groups, Mark Principato's swing signals, just update your preferences, hit the button, and you'll automatically be either added or removed. Depends on whether you have the checkbox checked for each one.
Okay, so if they don't want to hear, me just continue to end up talking about the stuff, they can uncheck market analysis, and then we won't send you the emails anymore telling you about
Exactly. Yep.
it. Okay, good. Okay.
And then
Tom, do we have
a couple other things. We just got our podcast approved for the roundtable by Apple. So I actually put a forum post on that, and I'm writing a blog article, but if you want to listen to the audio of the roundtable, like in your car while you're jogging, whatever, it's going to be available at Apple and also Stitcher. And then tomorrow is the first Trading Group 2 meeting, and I think Dan Harvey said he's going to be there, so it should be an interesting meeting. I'll probably go over that new trade that I'm working on, that floater, where it's basically a symmetric butterfly that you adjust the side that the market's on, you float it up. So it's working out pretty well.
Yeah, and if you guys remember, we had talked a little bit about this SPX trade. And if I can, might as well show. This was just an SPX trade when we first hit 2,000. Okay, I put it on some time ago. Tom has done a much better job because I left this 25-point wide butterfly. And, well, Tom, why don't you just kind of give him a quick preview of how you manage the sides?
Well, as the market started going down, I started basically turning it into a broken wing on the downside. It started lifting the put side, which pushed down the call side. And, kind of like almost like a lock, like the Panama Canal. So the water was going up one side and coming down the other. And I ended up making about $1,200 on a 10 or 20 lot. I think it was a 10 lot. I did the same trade, just a little smaller. And then I took it off, and then the market came back, and I put another one on at 1950. And now as the market's been going up, I've been raising the call side and lowering the put side. So now the expiration call side is actually above zero. So I think the short delta, the center of the butterfly, is something around a 15 or 18 delta now on the puts. So it's pretty high probability, and it's working out pretty well. Nice flat T plus 0 line, defined risk, it's all the good stuff.
Okay. Adrian, I see your question. I just want to end up seeing if there's anything else before we end up getting to your question. I didn't see anything else on it, Tom. I think we got all the questions.
Rod Menks had one. He said, could you go over your oscillators, what they are, the settings, all that kind of stuff?
Yep. Okay. Okay, so when I take a look at charts, and let me pull this so it's a little bit easier to see here. Maybe it's a drop on it. Okay, oscillators are basically something that'll end up, there are different types of indicators that will show you basically, if you will, the rhythms or the oscillations of the markets. They tend to end up moving in waves. And so what the oscillators try to end up doing is that they tell you if the wave is moving up or if the wave is moving down. And what you can end up seeing here, there is no one oscillator that will end up working perfectly. What I tend to end up doing is that I've chosen 5 that I tend to end up looking at. I don't believe that I have any special sauce. You know, if I use, you know, what's the crossover of the 21-day versus the 89.5-day, you know, I don't know. So what I tend to end up using is I tend to end up looking at things that most technical analysts would end up looking at. Not because I think that they end up working well. Could they possibly be self-fulfilling prophecies? You know, maybe if everybody's looking at the same thing. But I do want to end up seeing if they're giving me any insight to the level and the strength of the moves. So on this chart, and I have a couple of different ones, the way I end up doing this is that on Thinkorswim, I have a bunch of different things that I've labeled. So I have, you know, oscillators, okay, that I end up taking a look at. I also have momentum indicators. I tend to spend most of my time on my oscillator page. The oscillators that I end up using, and all of these are default standards. I look at the MACD, and if you go and you take a look at it, I'm using, you know, basically it stands for, you know, moving average, convergence, divergence. And basically what it's ended up showing me is the strength of a move. So you can see when we had this sell-off, that if I'm holding my cursor, let's say right around here, okay, this is where, I don't know if you can end up seeing that, right around, say, the minus, you know, 13 level. That's where we were on the previous sell-off. You can see how strong the sell-off ended up getting. It was gaining momentum. So as you can see, the red bars are getting red, you know, they're staying red, so it's actually picking up strength up until here. It's not to say that once the bars turn the darker red, that the movement, okay, down is over. It's at least subsided for the time being. And you could end up seeing that. You can end up seeing that the MACDs don't go positive until right around here, which was 1022. By that time, there were some other indicators that were already very strong. So on the SPX, I will tell you that if you take a look at MACD crossover points, that they tend to end up being the last to confirm, okay, when the market ends up moving. This isn't always the case. It is often the case, okay, depending on the underlying you end up looking at. And when you look at these all the time, you'll see which ones tend to be quicker. I will tell you that the CCI, the bottom one, okay, tends to end up being the first one to end up turning over and when there's a reversal. It's usually followed by William percent R, and then RSI, and then stochastics. The reason why I keep these in this order is that usually, not always, usually what I have seen in my experience when I look at the SPX, they're to the fastest moving on the bottom to the slowest moving on the top. That's the reason why I put them in this order, okay? It's the way I've gotten used to them, to take a look at them. they're all similar in the sense that if you take a look at the stochastics, you have a fast stochastic and a slow stochastic. I tend to end up using the full stochastics. So the purple line here, and I've recolored my stuff. So if it doesn't match yours when you pull up the defaults and all that, please realize that. So I can end up seeing that you end up having a fast stochastic, and once it got up above the overbought line, we can stay up there for a period. Usually, okay, you're not going to end up seeing any sell-off until you start to end up getting this, meaning that the fast stochastic is going to end up selling off. But you can see the sell-off we had here was minor. In addition to that, just because the fast stochastic, it bumps around very quickly, look at this noise here. This is a good example of what I talk about, and same thing over here, of living on the ceiling, right? We were up here for a long time. If I take a look at the MACDs, the MACD is close to zero, but each individual line is well above zero. So is it hard for, it's hard for me to end up getting really concerned about, a quick sell-off like this when the MACDs are this high. You can see it was just a minor thing. I mean, we barely even touched, okay, the 20-day exponential moving average, by the way. Those are my color codes up here, right? I have the 20-day moving average in aqua. Yellow is the, and you can see it right here, right? It's the 50. The orange is the 100, and the red is the 200. Okay. So by looking at that graph, okay, it's pretty easy to end up seeing. Now, Tom, if I hit share, this one, there's nothing proprietary on it. If I hit share and I hit stochastics and I hit oscillators, oh, no, that's not the one. And I just lost my mouse. If I hit share, uh-oh, I can't do that now. Okay.
Uh-oh.
Uh-oh. Okay. I'll tell you what I'll end up doing is I'll take it offline with Tom, and I'll see if I can end up sharing that, if that's okay with you. Okay.
If it's a file, if it's a file or something, Jim, I could attach it to the recording in the library.
Okay, that would be great. And because, and I'll just see if I can end up doing that one more time here. Maybe share, and then oscillators. Share an email, create link for sharing. Okay. I'm going to say copy. And then what I'm going to do is I'm going to come over to the chat and see if I can post it. And if not, you guys can copy it down. And Tom, what we'll end up doing is that we'll just make that link available for everybody. If we can.
Yeah, I'll put the link in the description in the library, so it'll always be there. It's interesting, TOS has a Mexican domain. That's kind of funny.
Oh, that is funny. I didn't see that. Okay. So we end up having that, and I think that should end up doing it, right? It's
Adrian had the covered call question.
Yeah, and I wanted to, and because that's not really part of the market analysis, I'd like to copy that. Looking at my screen, I'd like to discuss that at the end. So this way, anybody who wants to end up knowing anything about the market analysis doesn't sit through it. But those who want, you can end up just making a note at whatever time we start talking about the covered call.
Fair enough. So for those of you who don't want to stick around for the covered calls, thanks for joining us for the market analysis.
And for those of you who are watching this on recording and just wanted to watch the covered calls and joining us now, welcome.
Right, welcome, right.
Okay, the covered call strategy, Adrian, I assume that you're talking about the covered call strategy that I had mentioned with Dr. Duke, okay, when he was on, and he said, oh, that was a good idea. I never thought about that. Okay. The challenge with a covered call, and I'm having some problems with Thinkorswim right now, so if you want, maybe we can end up making this a whole separate section. This isn't much different than a, what I was referring to was oh God, Tom, what was it? It must have been about 5 years ago. I did a long-term investing class with Dan Sheridan on SOM. And basically, what I was looking at doing was that I, being the notorious cheapskate that I am, I wanted to be paid to buy stock, and I wanted to be paid to sell stock. So what I ended up doing, and let me see if Thinkorswim would be kind enough to doing this, and let's choose a stock. Tom, any covered call candidate that you want me to take a look at, or Adrian, any type of covered call candidate you want me to look at specifically?
How about IBM? That's a nice solid stock.
I used to work there, and I think that they're in a decline, but that's what's it. You know, I used to work for Ginny Rometty. She was like my third level manager at one time when I was there. She's the CEO these days. That's where I started my career. Okay, so what I would take a look at doing, okay, and this is just the general, okay, now granted, I'm answering the question. And so it's a general way to end up taking a look at this, is that I would normally look out, you know, maybe about a month, and we don't have a specific month, so maybe let's end up moving 2 months out. What I would end up doing is that I would do my technical analysis on IBM, see where the support was, where the resistance was. I'm not going to end up going through all of that right now. So let's just going and making up, you know, because they've sold off pretty significantly over the last few months. Let's say that I was comfortable selling 170 call, and I was comfortable selling a 155. Okay, so normally the way I would take a look at it is that I would take a look at saying if I had 200 shares. That's the way I would always build a system, so off of a 200 share system. What I would do is that I would start by buying 100 shares. I would start by buying 100 shares, and I would sell my covered call on my 100 shares. So I'd sell my covered call at 170, and then to try to buy the second 100 shares, okay, I would sell, not buy, I would sell, okay, my 155s. So this way, if it moves below 155, I would end up buying my stock, but if it didn't move below 155, I'd get to end up keeping my covered call money. Now here's something I want you to kind of take a look at. Take a look at my 170. My 170 is, let's say the stock price is 164.50. We'll round it to make our math easier. Okay, if I'm selling a 170, my call is $5.50 above the money. My put at 155 is $9.50 below the money. My put is significantly below where my call is when I measure the distance from the at the money. This is because when you take a look at what the implied volatility is, you can see that the implied volatility here is at almost at 18, right, 17.96, where the covered call volatility that I'm selling is only at 14. So I don't want to do covered call systems by themselves because I'm not collecting enough. I want to sell higher volatility. How can you sell higher volatility? You got to sell stuff below the money. Okay, so when I take a look at this in a graph, okay, and here's my graph, you can end up seeing here's my current price. My theta is $5.68. Pretty significant for 100, or in this case, you want to consider 200 shares. I will be long 200 shares if we get below my puts. So right here's 155. Let's put where the covered calls are, right? This is 155. This is 170. Okay, and let's widen it out a little bit. It's easier to see. Okay, so that's my range. I want to, right, because I don't want to end up having to buy too much stock. I only have 200 shares. So one of three things can happen. Either I finish below my put at 155, above my call at 170, or in between, right? Those are the only three possibilities. So what I end up doing is, let's say if we finish in December, we finish in between. Well, guess what? I get to end up keeping my $1.12. I get to keep my $1.09, right? So I've made a $2.31. That's money in the bank, and you know, rinse and repeat. Okay. Now, what happens if we move up? Okay, if we move up above 170, my stock, my 100 shares of stock are going to be called away from the covered call that I sold at 170. What I will then do is that I will redo the exact same process. But right now, when you redo the process and you don't have any shares, what do? If you want to buy them back, I guess you could end up buying them back. But what I tend to do is, you know, I also hate to pay commissions, part of being a cheapskate. What I'll end up doing is that I will then use just puts. Let me show you how that would end up looking. Say if the whole thing got reset. What I would end up doing, using the same strikes, but I don't have any shares, what I would end up doing is that I'd still sell that 109 put. But instead of buying the 100 shares and then selling the covered call, I would sell the 170 put. So look at the graph. It looks identical. Identical, right? So I'll just do the same thing, selling puts. Now, one of three things happens again. Either I finish above 170, in which case I don't get assigned on any of the puts. I finish between 155 and 170, in which case I get assigned on the 170 put, but the 155 put expires worthless. Or I finish below 155 and I get assigned on both my puts, in which case I now have 200 shares. So let's take a look at what happens with that. So at this point, what ends up happening, if I get assigned on both my shares, I have 200 shares, right? So I'm going to do the exact same thing, except for with all calls this time. I'm still going to sell my 170 call, but this time I'm going to sell a 155 call. Now, one of the things, this is Thinkorswim, deep in the money calls, you know, they don't end up pricing them very well. And so trust me when I tell you that if Thinkorswim actually calculated, okay, their graphs correctly with the deep in the money calls, this graph would look identical to the two other graphs that I showed you. So what I do is that I end up getting a stock that I want to end up playing with, that I understand really well, and I'm pretty good doing my technical analysis, and I just do this every single month, and I go over and over and over again. And if you have a very, stock where you're pretty familiar with the stock, and you're pretty good at, say, keeping the range, nothing works better than collecting the money on both sides. Now, can you do this, okay, with less than 200 shares? It's almost like buying them on margin. Right? The thing is, if I only had enough to buy 100 shares, what happens if I get assigned? So I'd rather it be considered 200 shares. I'm only putting up half the cash. The other cash is staying there in case I get assigned. It's a little bit more conservative because I only have 100 shares unless we get pulled back. And I'm collecting. I mean, if you take a look at this, I'm collecting $2.31 on $164 stock. So I'm collecting about 1.5%. Okay, and I have a pretty decently wide range. Tom, maybe if there's enough interest, we can end up sending out, if people wanted to end up seeing the covered call strategy that, I mentioned, okay, with Dr. Duke, and we kind of ended up doing here. Maybe we can end up doing, a class and going through a couple of examples, okay. If people are interested, why don't you shoot Tom, okay, Tom, if you don't mind, Tom an email with a couple of candidates, And the best thing to end up doing is just, putting it into option view or whatever back testing system you use and just see how it ends up working. Baba, I saw over there, Eddie ended up putting up. Eddie, the reason why I don't like to use a new stock like Baba is that the puts and the calls are probably, they're not well entrenched. Now, to your advantage, in something like Baba, they usually tend to overprice them more than they underprice them in the beginning, but they're overpricing them because there's more unknowns and more risk. And, their first earnings coming out, I think tomorrow, right? Sometime this week. And you'll end up seeing a lot more variance in it. And this is the exact opposite of having a lot of variance. This is a more conservative way to end up cranking out, options income on a regular basis. One last comment, and it's very, very important. When I look at IBM, okay, and I end up showing you IBM has a 2.7% dividend. Now, it's a little bit higher because of the stock pulling back. It had been a little bit lower. Now, when the stock pulled back, the implied volatility went in, so it's not a bad time to be doing IBM right now. However, if I was to look at something, I don't know, let's take a look at, this was my first client, okay, when I was in IBM. One of my best friends, their first client was Pfizer. Pfizer is almost at 3.5%. Now remember, the dividend is used to calculate what the option should price at. Now, unlike Thinkorswim, okay, other systems like Liveball actually end up saying, oh, if the dividend's going to be paid on this date, then you take a look at it. That's the date it should come out. Thinkorswim does it a lot simpler. They just take a calculation of, well, if the dividend is this much, they make believe that, 1/365th of the dividend is paid every single day. Okay, they don't end up doing it on a quarterly basis. Systems like Liveball do the discrete dividend. They end up going up to a public source, and if you think that your information is better than the public source they let you then using your own dividend and dates on it, and it'll end up calculating the implied volatility as it truly is, and then you don't end up getting that messed up graph that we saw in Thinkorswim. Okay. So that's pretty much it. If there's interest in it, I'd be more than happy to end up going through a class or two on it. Are there any questions, Adrian, or anybody else on it? It's really not rocket science.
Yeah, this one last question. The IBM example, would you do anything different with this strategy during earnings?
Very, very good question. What I remember, okay, because this is going to be the steady growers that I end up liking, or steady stocks. I would make sure that like for example, if I was to go and sell a stock, I like to actually sell the week or two before earnings, and then sell another one, maybe even a little bit tighter, right? A little bit tighter. Right after earnings. I want to collect all of my premium that I can. I want to get the full, increased volatility that I can get for selling the earnings. And if it was somebody who I'm not afraid of owning, very, very important point, somebody that I'm not afraid of owning and owning for the long term, then yeah, I sell those puts, going into earnings, because you know that you're going to end up getting an increased amount of premium because the IVs are going to be so jacked. Okay. So, sorry, I'm getting a lot of text messages and calls.
I think people need to talk to you, Jim. So I think we've run out of questions.
Okay, good. Thank you very much. I hope the covered call strategy was, the overview I gave you was a quick and dirty one. If you wanted to end up having, more examples, and if you guys had candidates and you'd like to end up doing a separate a webinar session on it, I'd be happy to put something together for you. I will tell you though, if you want me to end up doing it, it's probably going to end up having to be in about 2 weeks or so, because my next 2 weeks are kind of busy.
Okay.
Thank you, everyone.
Thanks, everyone. We'll see you later this week for trading groups and the roundtable.
Sounds great.
All right, we'll see you.